All right, go ahead.
Okay. All right. Thank you all for having me here today. I see a few participants, so I truly appreciate your time for coming on, wanting to, expand your knowledge in the 1031 exchange space and how it applies to you in the market today. A 1031 exchange, the entire process of it was created in 1921. So exchanges have been around for almost a century. It's a lot of exchanges. And the company I work for, Asset Preservation, we're a qualified intermediary, also known as an accommodator or facilitator. And myself, my name is Kayla Frerking. I will be helping you as far as along the path today on education and how it applies to your specific farms, ranches, and other investment real estate we have. I'm a division manager for our national accommodator. I specifically work out of San Diego and Orange County. As far as the exchanges we do, mostly delayed exchange, a ton of reverse exchanges. We have built to suit exchanges, improvement exchanges, goodness, all the complex types of exchanges that we can benefit any really interested real estate investor. So nothing is too complex for us. So I'm going to review through a bunch of different slides today, and I'd really like it if you guys want to engage with questions as I go through. Unmute yourself, fire away with the questions. This is a safe space. We're all kind of on the same page as far as knowledge is what it sounds like. So I'm going to start with some terminology and then dive into some visuals of what the structure looks like, and finally get to the point I think that we're all waiting for as far as farms and ranches and the overview. So just kind of getting in the know with the terminology, how the tax code works, and then dive into it personally. Now, some terminology I'll be saying today is actual receipt. Actual receipt of funds is ultimately selling a property and collecting cash. So you're in actual receipt of funds. Boot is anything left out of an exchange. So in a 1031 exchange, you sell real estate as an investment and use the proceeds to purchase more real estate as an investment. In a normal sale, you sell a property and collect cash. In a 1031, you sell real estate and acquire real estate. If any amount of cash is taken out of that equation for real estate to real estate, it's classified as boot. Now it can be cash boot or debt boot, meaning if you have a property that's selling and you have a mortgage on the property, you can either go down in value and have a portion of it come from the debt or the cash. So boot is anything that's not real property. Constructive receipt is essentially if a client hasn't set up a 1031 exchange and there is a check in escrow when you go to sell a property. Anytime that you sell real estate, you have to open escrow, right? So you have a middleman, mediator, transaction coordinator, if you will. And if there is no exchange set up, it applies that you are technically in constructive receipt, which is a no-no in the 1031. Our goal is to set up the exchange prior to that point. Whenever I say exchanger, investor, or taxpayer, they are essentially the same person. Our exchange agreement is what we need to set up prior to close in order for you to have that open exchange. The exchange period, according to IRC or Internal Revenue Code, Section 1031, is 180 calendar days. So it's 6 months. Where the ID period is 45 calendar days. Now, obviously, as mentioned before, I'm going to get into slides and really dive into more details of this. So I don't want this to be going over anyone's head to slow down, because I promise we'll revisit all of these terms. Now, like-kind property is any property that's held for investment in real estate. I went over mortgage boot, and then qualified intermediary is our company. So we're essentially, I like to say, we're the middleman in between the sale of a property and the purchase of another property. We just hold the cash in between. The relinquished property is the investment property that the exchanger is selling, and the replacement property is the property that the investor is purchasing. As mentioned, exchanges have been around for almost a century. So in the long term of all tax codes in the history of the US, it's not that long to have exchanges. They actually were amplified and a little bit more strict when it came to the 70s for a Starker case with lumber. So originally they were created if someone owned, let's say, an apple orchard and an orange orchard, and you just wanted to swap deeds. Maybe someone wanted to get out of apples, someone wanted to get out of oranges, and you swap, okay? Today, we have different implications for the value of real estate, right? I mean, we're talking the plot of land, fertile soil, any type of indirect or direct sun. So all of these factors are put into play when selling any type of real estate. So hence a little bit more of scrutiny under the tax code to create more restrictions and advantages for investors to not just swap real estate, right? So if someone's selling for $1 million, someone else is selling for 5, doesn't really work for the same across the board. So the 1031 allows the taxpayer holding real property for investment in a trade or for business purposes only. So not primary residence, only investment property, right? Now, some tax codes that get mixed up here and there in our structure. First and foremost, as mentioned, 1031, just think 100% investment, all day investments, commercial, vacation homes, agriculture, everything is investment. Section 1033, involuntary conversion, that's essentially eminent domain. Government gives you cash, takes rights of your property. That's no fun. Section 121 only applies to primary residence. And then I'll get into the weeds here down the line about a combination, a really unique combination for farmers and ranchers to use 121 and 1031. Section 453 is an installment sale or seller financing. So in the real estate industry, when someone says, I'm going to sell my property and there's a note, right? So it's essentially you're holding a note for the new buyer and you're getting paid interest on that. You're acting as the lender. That is excluded from a 1031 because you're making a profit on paper that you're holding. So all the way back to the original goal of the 1031, sell real estate as an investment and buy real estate as an investment. No cash in between, which paper, or in this case, an installment sale, which is what we call paper, holding a note classifies as that. Another question that comes up a lot, can I take my investment property and exchange it into a REIT, real estate investment trust? No, you cannot, because again, it's a piece of paper or interest, and that piece of paper then owns different assets. So while you can be an investor in a REIT, the REIT is the one on title as the taxpayer doing the exchange. Does anyone have any questions at this point? It's okay if I hear crickets, I get it. Okay, so moving on, capital gain taxation. Goodness, this is getting even higher and higher. Every, I feel like month we're ticking here just waiting for this recess to come up here in July, and we'll have a little bit more clarity on what's happening with our tax increases in September of this year. So as far as what we have now, currently capital gain taxation includes 4 components. Depreciation recapture tax, so anything you've depreciated on property, that's at 25%. Your federal capital gains tax is at 20%, or it could be 15%, really depends on your specific tax bracket and income. You have your net investment income tax at 3.8%. And then lastly, in this little bracket you see below is 0 to 13.3%, depending on your state tax. Believe it or not, we are actually at the top end of that at the 13.3%. I know that the plans are to increase that, knock on wood that we don't go too high over that, because we are the highest in the country at the moment. Now in 2021, this always shifts every year. The numbers that you see on your screen for the 20%, this is how you can gauge that. Am I paying 20% on the Fed level or 15? So single filers exceeding 441,550, or married couples filing jointly 496,600 will be at that 20% or above. Anyone below is 15, okay, or less. Now, when I said net investment income tax, so that's our NIT tax, right? Our NIT tax is essentially healthcare tax, right? And it's 3.8%. No matter where you live in the country, everyone pays it. So, you know, we're breaking down these numbers right now of the depreciation recapture, federal, net investment income, and state, and ours is at that 13.3% here. That's a lot of taxes on capital gains. People ask me, what's the round number? Well, what am I going to be paying? We don't give legal tax advice at asset preservation. You know, we're strictly accommodators. So we usually have all of our clients talk to their CPAs or tax advisors. So either one works for your specific number. We also have a helpful capital gains tax calculator. Standard for me, if I'm looking at a ballpark, on 35% or more is the average that I see people paying capital gains taxes. So pretty high for holding property for a long time and then hoping to have all that cash put back in your pocket and it's going to Uncle Sam. So here's the scenario, right? It all comes down to my investment real property. I have the asset and I decide I'm going to hold the property. I hold the property for so long and I decide there's an opportunity to sell. You know that when you sell, let's say you bought a property at 500,000 and now it's valued at $1 million. So 500 for a basis, which is what we call the original purchase price. And then a sales price of $1 million gives you a $500,000 gain. Now, going over those last numbers at 35% of that 500 on average could be more. It brings you to wanting to do a 1031 exchange. The 1031 exchange allows you to redeploy that entire $1 million, less closing costs, so what you pay brokers, whoever's listing the property, the realtor, and then also escrow officers and different various closing costs between you and the buyer. So take that $1 million, closing costs at around, call it 5%, say you're reinvesting 950,000 about, okay? So that 950,000 could then be exchanged entirely into more real estate. So you could take the $1 million and divide it between 2 different rental real estate vacation properties, a tenants in common in a larger commercial property. There's really various alternative investments for you on the table. Now, this is strictly from the tax code. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade, business, or for investment, hoping that the exchange property is held in the same manner. So you cannot take an investment property and exchange it for a property you intend to live in immediately. Now, you can exchange an investment property for, let's say, a beautiful vacation home rented out on Airbnb for at least 2 years and then convert it to your primary. So there's little tools of the trade here that you can do, but really the goal of the IRS is the intent to hold for investment. So stocks, bonds, securities, interest when we talked about the REIT, right? And also interest in a partnership. If an LLC or a partnership sells and you own, let's say, your farm in an LLC and one member doesn't want to exchange and the LLC does, the LLC must perform the exchange. You can't really piece out one member. There are a couple tactics for it, but it's very complex. So the goal is the real estate for the real estate, not the percentage interest and in the membership or the partnership. So here's a little bit more clarity on that. So Kayla Frerking owned a vacation condo in Oceanside. I recently exchanged that condo into an investment property in Big Bear. I'm holding that property and recently got married about 2 years ago, and my husband wanted to be on title. Lucky guy, right? Unfortunately for him, wife relinquishes, Kayla Franklin at the time relinquished. Kayla Franklin is still on title as an unmarried woman. Now, when I hold the Big Bear property for more than 2 years, I can quit claim deed title and add him into our family trust, right? So we can put our trust on it at that point. Again, I'm using that 2-year rule, so that's a good timeline to hold conservatively. If you want to change titles, again, that's still 2-year holding period. An LLC sells, LLC acquires, so on and so forth through the list here that you see on your screen. Now, I covered a couple types of investment property, vacation homes. We have oil rights, mineral rights, easements, cell towers classify. We have on your screen here also the tenants in common structure in commercial or a Delaware statutory trust. Lots of information here. I know if something really perks up your ears, stop me and we can cover it, or you can contact me directly after this and we can go through your specific scenario. Visually here, I just want all of you to take in for a second that when you exchange, you don't, like-kind property isn't I'm selling my farm for my farm. You can get out of the industry and exchange into a different avenue, or talk to someone in commercial, brokers that are looking for a lot of people that are getting out of the commercial space and wanting to exchange into agriculture. So lots of variations here in partnering with people looking to buy or sell. We talked about the principal residence or held for sale dealer property. I don't know why we have this listed here for us in California. They're called flips. I don't know if any of you watch HGTV. It is one of my favorite shows. But you know, all the flips, the flip or flop, those do not classify in an exchange. Reason being, someone exchanges real estate and their intent is to not hold for investment, right? So originally when I was stating that the 2-year holding period, some CPAs will advise our clients a year and a day for holding. Usually anywhere between a year and a day to 2 years is a good timeline. Obviously anything over that 2-year threshold, you're in the green zone as far as being a positive or perfect storm 1031 if you fully defer all of your capital gains by reinvesting the proceeds and the debt. Excuse me. So the IRS looks at different factors, one of those being that holding period, right? And making sure that to the core, you're paying income on your Schedule E in some capacity of the ownership or the taxpayer on title to a property. Schedule E, right, when you file that, you know that you have income coming in, so you're already paying taxes on income coming in. That's kind of what allows the 1031 for investors. Uncle Sam is aware you're paying taxes, so redeploy that growth and economic value and put it back into the real estate market, allowing for people that maybe can't afford a single family home and a down payment to rent it, or they want to get out of their investment properties and purchase agricultural land or commercial, so on and so forth. So here's a little bit of the equation before we dive into the visual of how the function of the tax code works in a transaction. So let's say we start with a taxpayer who owns a property and they're selling it at $900,000. This person has $300,000 of debt on the property, and the cost of the sale, so selling, you know, obviously the broker dues and escrow, things that happen in the sale of a place, are $60,000. So that takes the 900 less 300 less 60 gives you 540,000 cash. Now they decide, okay, I'm going to reinvest all my net exchange proceeds and acquire the same or greater debt. I found a replacement property on the market for 1.2 million. This person decided I'm going to take the $300,000 loan that was already paid off, talk to my lender, and assume a loan in the amount of 660. So they went up in value. And I also want to replace my 540 that was sitting with the exchange accommodator. So they've fulfilled both the debt replacement and the cash replacement, giving them zero boot, meaning full deferral. They're not taking a hit on capital gains taxes in any amount. Okay. Now in this example, I just kind of put everything out here so you can see it on the table. Same exact seller sold the $900,000 property, but they found something for $700,000. Okay. So in my mind, I instantly think 900 minus 700, that's $200,000. In this equation, we're missing, in my recent example, the cost of sale. So you take the 900,000 less the 300 less the cost of sale, which gives you that same net equity of 540. So this taxpayer replaced only 440, taking 100,000 and putting it in their pocket, cash. And they decided to only acquire a loan in the amount of 260, going down in value by 40,000. So at this point, they have $140,000 that was removed from the exchange equation, which is actual receipt of funds and debt relief, and it's classified as boot. So the $140,000 is the only portion that's taxable by election of replacement property for this investor. Does anyone have questions on this? Because I know this is a little complex for the equation. Okay. So here's a visual. This helps me a lot in these classes and meeting with clients, just to give you an idea of what happens in the transaction. So you start off with your farm or ranch and you decide to list it, okay? You're the taxpayer, you list your property, and then your amazing realtor or broker that you're working with finds you a buyer, right? You opened escrow. So that means that you've agreed to terms. You're now in escrow where proceeds are being held and different opportunities are being examined as far as looking, investigating the property, contingency removal periods happening, meaning the loan is funded, different things happening on behalf of the buyer and the seller. Now, once you decide on the close of escrow date and we've set up the exchange agreement, the exchange agreement dictates that the proceeds will go directly into the qualified intermediary account, asset preservation. So we hold those proceeds within certain regulations and restrictions, and then wire them over to the replacement property where you become the buyer purchasing from a seller, right? So you're switching your hat. And at that time, we direct deed back to you, the taxpayer. So when we see this visually, it's a big circle, right? You sell, the proceeds go to the accommodator or qualified intermediary, then over to the new escrow to purchase the property. Now, the tricky part here is looking at the time requirements. When I said certain regulations and restrictions, we begin with day of close starts a timeline. That timeline begins where you have 45 calendar days to identify replacement property. Oh, I see here, Lori, thank you for your question. How many properties can be identified? Yeah, great question. Okay, perfect timing. Next slide, right? Okay, I'm glad we're on the same page. So 45-day ID period begins the day of close where you have 45 calendar days to identify replacement property. And then an additional 135 days to close on one or all of the properties you've ID'd. 45 plus the 135 gives you a total of 180 calendar days, so that entire exchange period. I know some people chop it up differently, but I want you to be aware that in the entire 180 exchange period, that 45-day ID period is inclusive. It's not in addition to. So that's why I say the 45 plus the 135. Now for Lori's question, in that 45-day period, what can I ID? There's 3 opportunities for rules here within the tax code. This is the first one, the 3 property rule. You can identify up to 3 properties at any fair market value. This would be for the investor that wants to sell their farm or ranch in exchange, maybe into one big vacation rental on the beach somewhere, or maybe just 2 different smaller ranches or farms, maybe 3. So you're only diversifying up to 3. When you identify those 3 properties, that does not mean that you're forced to close on all 3, okay? So that's just an opportunity. I ID'd property 1, I have a backup for 2 and a backup for 3, or as mentioned, you can diversify. Now, the second rule is the 200% rule. It's kind of flip-flops 3 property. It allows you to identify as many properties as you would like, but the total amount of value of all of the properties you've ID'd cannot exceed 200% of what you've sold. Example, you sell for $1 million, let's say you net $1 million, so this is after closing costs, and you go ahead and identify 5 properties, okay, all at, let's say the first 4 are gonna be at a quarter each, so 250K, 250K, so that suffices for the $1 million, okay? Now the last one, the 5th one, let's say it's 1.1 1/4, $1,250,000. If that happens, the total of those is now $2,250,000, and you've ID'd 5 properties. 200% of $1 million is $2 million. So you've now exceeded the 200% rule. How that would work is if you took the $1 million and let's say ID'd those 5 properties and they're all valued at 200 each, right? So you're not exceeding 200% of the $1 million in totality. So this is more for the person, the investor that really wants to take their bulk money and exchange into several different diversified alternative investments. And I know here in Escondido and San Diego, where we are, property like that really isn't available for 200,000 very often. Sometimes, some land is. Even now, I know in Fallbrook, we're seeing on average around 275 up to 500 right now, which is outrageous depending on obviously acreage, but we're talking a couple acres. So those tools will be used. The 200% rule is used for a lot of my clients that diversify maybe into Detroit or Tennessee. So many exchanges are getting out of California, taking their investment property, moving to Texas, Florida, so different states. Now over here, the 95%, This one really isn't used that often. The 95% rule combines both, where it allows the taxpayer to ID as many properties as they would like, and they can be any combined value. However, they cannot eliminate one from the equation. For example, they have to close on all. If they ID 10 properties, they cannot close on 9. They have to close on all 10 or the 1031 is invalidated. So this is someone maybe who's selling an asset and wanting to buy investment property, maybe from a developer that they know it's going to be a brand new rental, and I call it Oklahoma, right? So it just really varies using these different rules. So again, 3 property rule, ultimately sell one, buy 1 or 2, 200% rule, diversify beyond 3, and 95% rule if you're really looking to capture several investment properties. Now, your identification rules, you must unambiguously describe the property. So we need the address, right? And it needs to be sent in by the 45th day at midnight. You cannot change your properties after the 45th day at midnight. However, if it's before the 45th day, you can. Now, side note here, if you do not ID, say you don't find replacement property by the 45th day at midnight, what happens? The proceeds that the accommodator is holding are then returned to you, the taxpayer, and you're facing a taxable event because you're in actual receipt of the funds now. So the goal is to have something ID'd, or rather be in escrow with that property when you're approaching this timeline. I don't see any other questions for now, just checking. So this suffices with that 3 property rule, right? So same example that you open escrow with a buyer, proceeds go to the accommodator, asset preservation, and then you diversify. You can use the proceeds to buy, using the 3 property rule, 3 different assets. So that's completely acceptable. And you can divide these 3 different assets with different investors as long as you keep the same taxpayer ID for your fractional purchase, right? So let's say you're a third investor, as long as it dictates that on the deed in the purchase agreement and your fraction is going in as you being the taxpayer. Now, farms and ranches, what can I exchange, right? So there's a lot of questions on, okay, what's available? So you can definitely exchange all of the land, and you can exchange uncropped land as well. So anything that's cropped, you've now removed from the land, and it's classified as a personal property, which is not exchangeable as of 2018. So anything that you see here on this list, water rights, mill rights, caretaker's quarters, a barn used for investment, any of those will classify in the fair market value in your exchange. Now, let's say you have a dwelling that you live in, which most people do, on their farm or ranch. That is excluded. So is goodwill, inventory, they're not exchangeable. And then livestock, stock and equipment. I did look up today that legislation created a tool allowing for immediate expensing of different types of newly acquired business assets. This isn't something I specialize in for the other type of asset. So if this is intriguing to you, definitely discuss with your tax advisor. Hopefully they'll have that tool available for you. So back to the option of saying you have your entire farm with, let's say, a barn on it, right? You're using it, everything, storage is in there. So that applies to a value of, let's call it $1 million, and your home is another $1 million. Well, it's your primary home. How do you do that? Section 121 is classified as primary and allows you an advantage of exclusions, right? So those exclusions include, if you're a married filer and you've owned the property for at least 2 years, you get an exemption of $500K on the gain portion. Anything over that is taxable for the 121 because it's a primary. Now the 1031 for the farm, you can utilize that and exchange that portion, use the 121 exclusion on the primary and take both. It's a home run. It is unfortunate that we do only have that cap on the primary because a lot of us hold property for a long time. So we're seeing, the gain on these properties go up higher than $500K. So either way, there's options to use these tools together. 1, just doing the outright 1031. 2, using that 121 principal residence sale, whether it's 2 separate. Or 3, a creative one is the split treatment as mentioned, right? So you have part of your land is going to be exchanged into another type of investment. And then the other portion is going to be used for you in exclusion and a tax write-off. Now you can convert a rental into a residence. So let's say you exchange that farmland into a vacation home in Vail, Colorado, right? If you go ahead and do that, you hold that rental property for at least 2 years, you can then convert that property into your primary and move into it. Now you'll have the advantage of a combination of the rental into residence, or on the flip, residence into rental, taking the property you live in right now, moving out of it, converting it into a rental property, and then exchanging it. Now, there's a variation of combinations on these, and what is over the 500, can I use it for an exchange if it's a rental? And I've combined these two, absolutely. So different tools here. If you have questions about this on a personal level, call me so that we can discuss your personal situation and see if we can get to the root of it. Next question, how many months over the 23-year period must the 24, sorry, Lori, how many months over the 24-month period must the rental be rented? I'm a little confused on the question. So really, if you exchange into, let's say, that vacation home example, and you hold it for 2 years, you can rent it out for as many months as you want. It's your rental. So it's up to you to do with it what you wish. Now, this is just an example. If you wanted to convert it into a residence, you can. You have to live in that property. Say you want to sell it, you'd have to live in that property for at least 3 years, a total of 5. Okay, so that's an option. You're utilizing the tax code a little bit there on the 5-year holding. So that's a combination of the two. I think that's what you were looking for your question. If not, go ahead.
Can I ask you a question on that?
Yes, please.
So if you're exchanging into a quote unquote rental,
Yes.
you have to rent that property for a certain amount of time. Like, does it have to be for 1 month out of that 2-year period before you can then make it your permanent residence, or?
So it needs to remain an investment property rental for at least 2 years. Now, there's a specific RevProc or rev. It's just a procedure that was put in the tax code that is an advantage, in my opinion. It's 2008-16. It's vacation home, because when you have a long-term rental, it gets depreciated rather quickly, right? It just, people don't really take care of a lot of rental homes. So you can use it as a vacation option, right? Meaning in that RevProc, you hold it for those 2 years. Each individual year, you rent it out for a minimum of 2 weeks to, say, a family member or someone on Airbnb. So again, for 2 weeks each individual year. And that allows you as the taxpayer to use the property for the same amount of time, 2 weeks. Not a lot of time, I understand that. The other variation of that same revenue procedure allows you to hold that property for 2 years, run it out for as much time as you would like during each individual of those 2 years, and then you can stay in the property for up to 10% of the time. Okay, so let's say you rent it out for 6 or 9 months and you want to capitalize on that and use it during peak season, 4th of July, Christmas, the holidays, you can go ahead and do that. So it's up to you as the investor, but that tool is available. I hope that clarified a little bit for you, Lori. I'm going to move on to the next one. If anyone, does anyone have any other questions on that while we're on the topic? Okay. So this is the Form 8824 like-kind exchanges. It's what you will file once you've done the next following tax-paying year, if you've done a 1031 exchange. Now, when we're talking about identifying property on an ID form created by your accommodator, we provide that for you. This is the form you will fill out. We need to use those forms to input it here, right? What is the property address I sold? What is the rule I used? What was the basis that I purchased my relinquished property at? What was the sales price, the debt? Lots of fun numbers there, right? So hopefully you guys have good CPAs. I have a few Rockstar referrals if you need one that are very versed in this. This tax form for me is great as far as keeping you guys aware the multitude of options in here. you'll see on the left page, related party exchange information. Can you sell to a related party? It gets a little tricky. The government doesn't applaud exchanging to related parties. It's kind of in the gray zone. The goal is, if you are exchanging to a related party, say a family member, right, a sibling, that both of you have to hold the new replacement property for at least 2 years. So meaning you hold the farm, you exchange it to your brother comes in, holds the replacement property, cannot collect cash, right? So you can't collect the cash, you exchange out into more property. That way no one's holding money. The limitation on taking boot in a related party exchange is 5%. 5% of that sales price of boot. Why? Lots of these come up, especially in San Diego, for related party and agriculture. Just some people want to keep the legacy going. Some people are burnt out. They want to get out of the industry. They do that because, let's say in that same scenario, you sell to your brother and you take the cash and you're not exchanging. What happens to that money? Can't you just put it under the table and give it as a gift? Same thing applies on the flip. If you're now exchanging into property that your brother owns, so you're taking your investment into a related party and putting into that asset. Now your brother doesn't want to exchange, so you've now exchanged in there and he's taking cash. He can easily just give it right back to you. So the goal for him in that scenario would be to exchange into more real estate or buy more real estate with the funds. So it gets a little tricky on the related party end, and just a little caution needed there. Now, it's key to perform due diligence on your QI accommodator. Lots of people around San Diego have been very corrupt in this industry. We are non-regulated, okay, so that's a big deal. The only type of format that we have for a membership policy as an accommodator is with the FEA, which is the Federation of Exchange Accommodators. Anytime that you're looking for an accommodator, my advice to you is to go on the fea.org website and see if they are in there. Just like when you research any realtor, you can go on I think it's calcrbe, right, .org, and look up someone's license number or name and see if there's anything on their file, right, in their history. Reason being, if an accommodator is wiring your proceeds into an account that all of you on this Zoom is holding into one big pot, I don't know about you, but that doesn't make me feel good. So make sure that the accommodator you are trusting is backed by accredited investors, has different variations of security. So API, our company, we're backed by Stewart Information Services. I'm sure you've heard of them, Stewart Title. We offer a letter of assurance upon request. We have high and tight financial controls within our industry and our company. So we never, ever, ever commingle funds. We segregate each and every individual taxpayer account. So when I set up an exchange for each and every one of you, it will have its own individual account. And currently we're with Citibank and Capital One. So right at close of escrow, those proceeds go into that separate account that sit on behalf of you underneath our company umbrella. Okay. As mentioned, we facilitate over 200,000 exchanges. So no exchange is complex. If you have questions, let us know. We have coast to coast division managers, I think 8 other of my position across the board here, and senior exchange counselors who I will assign to you given your transaction once we qualify your exchange. So I do want to leave it open for a little bit more questions here. This is some other information if you want to use LinkedIn. I don't really do Twitter, but our company's on there. I'm on LinkedIn. I'm more of a face-to-face person, or on the phone if you guys want to contact me. This is my direct office line, and then my cell phone and my direct email. Oh, perfect. I see more questions. Okay, perfect. Lori, I got your question. And Andrew, I was wondering if the industry is regular. Oh, perfect. Okay, so I covered it. So no, we're non-regulated. Again, that is kind of scary. So make sure that your accommodator is trusted, right? I've worked with another accommodator in the past, great company, just wanted to be with a larger accommodator because of that. I'm a very ethical, moral person. So when it comes to holding funds, I don't want to have to back and spit fire on something and what could happen in the worst case, right? So this company is highly secure for you and your investments. And I would really love an open forum if anyone else has questions, or down the line, I know Katie and I were talking about potentially doing this is recorded right now, so I don't know where it will be sent. I'll just be in my glasses being famous on your guys' forum. I have connected on the Facebook page as well, but down the line, if you have other friends and members here, let them know, and we can jump on a call together. But I really appreciate all of your time. I know it's a lot to take out of your day and jump on and stare at a screen for a while. So I'm going to offer one more time. If anyone else has any other questions, fire away. Okay. All right. Well, thank you so much for everything. My contact information is up there. Katie, thank you for your time and setting this up for me. I really appreciate it. The goal is to be informative and just help where we can in the industry. And this crazy time to be alive where taxes are going up and up and up. So we hope we keep this tool in the tax code.
Yes, thank you very much, Kayla. And to answer your question, this will be on our website under our past webinars. And so if anybody wants to go back and see another part again, then that's where it'll be. And then I'll send you a copy as well so that you can distribute as you see fit.
Perfect, perfect. Well, thank you so much. I hope you guys have a great afternoon.
All right, thank you. You too.
Okay, bye.
Bye.